Okay, welcome back everyone. We'll get underway. A reminder again, if you want to look at the presentations, find out more about the presenters, etc., you can scan that QR code on your table and you'll get more information there. So, we've talked this morning about collapsing banks in the USA, we've had war in the Ukraine, fun times globally, and a good time maybe to talk about international equities. Our next panel is going to talk about where there might be opportunities in international equities. Moderator for our panel is Paul Saliba. Paul is the founder of Evolutionary Portfolio Services. Please welcome Paul and the panel. Thank you.
Good afternoon and thank you. Hopefully you enjoyed your lunch. Where to look in international equities? So obviously global equity markets have been buffeted by one of the largest and fastest interest rate rise cycles in history. This saw the MSCI ex-Australia on a hedged basis fall 18.1% last year. Emerging markets were down 14.3% and the S&P 500 was down 18.1%. Of course, this has affected growth stocks significantly, with the Nasdaq being down 33.1%, excluding the income from those stocks. So what we're here to do is discuss where we might look given a different interest rate environment, a different inflation environment. So we have Pruxa, who is the Senior Investment Director at Aberdeen. Next to her, we have Monik, Chief Investment Officer at Insync Funds Management. And then at the end, we have Alex, who is APAC Investment Strategist at Russell Investments. So they'll each present a short presentation and then we'll have some discussion and Q&A. Welcome to the stand. Who's up first? Alex, I think.
Perfect, thank you. Thanks, Paul. Thanks everyone for your time. So, yeah, I'm the investment strategist for Asia Pacific at Russell. So I thought we've got 5 minutes, I think, talk through how we think about markets and our process for building portfolios, and then quickly go through how we're positioned in our global portfolio right now. And then I think there's quite a few topics to discuss, hot topics. So in terms of how we build portfolios, so we're a multi-asset shop, but we also have our bread and butter historically has been in manager research. So we have a dedicated manager research team for all of our asset classes. So for global equities, there's 3 or 4 around the world that manage the best in breed investment managers that we think of. We look at 15,000 products, continually research 8,500, and of that, only 700 are given a high rank, and then 240 are used. So it's a pretty strict and hard process to get through. You can see here though, our higher rated products on average have outperformed by 1.64%. So pretty consistent alpha that's come through from this manager's research selection. On top of that though, we think about where we are in the cycle, and we obviously have our own tactical tilts and various other things within both global equities and our multi-asset funds. And as a house, the way that we think about it is through cycle valuation and sentiment. So they're the 3 pillars that we talk about across every asset class. It's not just global equities. This is our multi-asset, our fixed income, currency, you name it. So in terms of our house view, and we'll get to the positioning, but the way that we're thinking about the world right now is it's not as probably grim as the last session that's coming on, the coming recession that I think you guys have before you go to drinks. But we do think recession risk is elevated in most of the Northern Hemisphere this year. I think we're at 55% probability of recession in the US, so more likely than not in our opinion. That was before SVB. That's not impacted by the SVB situation. Here in Australia though, I think it's quite encouraging, and Asia more generally. Recession risk we think is more moderated. You have obviously the benefit of China, and also in Australia we think that the economy is in a reasonably healthy position, and it doesn't help, it helps quite a bit that the RBA are proving to be a little bit more cautious than their counterparts in the Northern Hemisphere. In terms of valuation, this was a big driver, and sentiment. These have been big drivers for us over the last 2 years in our global equity portfolio. So coming out of COVID, we saw pretty positive sentiment and cycle support for the value factor, so for value stocks, And we went pretty heavily overweight into value at that point in time. And then as we went through last year and we started to see those signs that the Fed were going to push further and further higher, increase that recession risk, we started moving out of out of the value space and moving into a bit more defensive and in lower volatility stocks. So you can see here on the far right, this is basically our lineup of managers for our World Equity Fund. And the APS is like an in-house strategy you can think of. And what we've basically done in the last 2 years, or 1 year really, has been just taking away some of that money from value and moving it towards lower volatility stocks, just because that recession risk is heightened. We do think that there is more volatility to come in equity markets through this year, given our macro view. And I guess the other part to note is that we've also been dedicating more capital to regional specialists, particularly in emerging markets. And we've seen our emerging markets managers, and I'm sure we'll get into this in more detail, they were very heavily underweight. Our emerging market funds was heavily underweight China up until about August last year. And we started plugging that within our own proprietary positioning strategies. We just weren't comfortable with the risks there. Since then, though, pretty much most of our managers have moved overweight into China. So that is one of the areas we think that is quite attractive in international equities this year, is Chinese equities and lower volatility stocks more generally for the globe.
Terrific, thank you. And
welcome, pleasure to be here. So the year ahead. So uncertain times, it's always uncertain, right? I mean, God, I've been doing this for 30 years, and when I first started, it was Iraq War I, Iraq War II, we had the Asian financial, anyway, the list goes on. I think you're all very familiar with it. So we're in uncertain times again. So what does that all mean for investing? And where we focus, as this slide shows, is we're very focused on global megatrends. Now, this is an interesting chart because it goes back a very long time, in fact, over 100 years. And there are basically 3 lines on this chart. The green line is basically PEs. Well, you know what, they go up and down, interest rates go up and down, and you get valuation compression and you get valuation expansion along the way. And we spend a lot of time thinking about it and trying to reposition the portfolios accordingly, trying to capture whatever the next wave may or may not be. Good luck, right? But the reality at the end of the day is 2 things actually stand true. And one is that, well, one thing stands true really, is that if you look at the red line, that's earnings over time, okay, going back 100 years. And what actually happens is the blue line, price, actually follows the earnings over the long term. Okay, so we've had periods of high interest rates and low interest rates, high inflation, low inflation. But really, it's sustainable earnings ultimately that drive share prices in the long term. And certainly we at Insync as fund managers, we believe if you just focus on that, you can find businesses that can deliver that, then you've got a good chance of doing well, rather than trying to work out what is always a very complex economic environment with thousands of moving parts, trying to work out where are interest rates going to go, where's inflation going to be. It's really interesting, by the way, and it is fun to talk about, but we believe this is far more important. So this is a slide of LVMH, Louis Vuitton. It's the largest luxury goods company in the world. And this is a 10-year chart. So again, just get this right. So I think the white line is the price and the blue line is the earnings, okay, going back the last 10 years. And you can see again that, look, from time to time, the 2 sort of part ways, you know, and last year was very similar for a lot of really high quality companies. You know, earnings kept going up, but the market sort of did what it did last year, as we heard at the beginning, came off a little bit and hurt all stocks and hurt really good quality companies as well, and that does happen from time to time. But you can see during that period, Louis Vuitton, this is going through 2022, that was the tough year, earnings just kept moving up, right? And so you can see there's a tight fit between the 2. If you can find businesses that can keep on growing its earnings, then the share prices will follow suit. Now, what are the attributes of LVMH? What are the attributes we're looking for that we believe have the sustainable earnings growth? Well, one is that they've got to be insanely profitable. Okay, if you buy really profitable companies, well, you know what? You get through good times and bad times. At the moment, you've heard about what's happening in the banking system in the US. Similar thing happened in 2008. But you know what? The strong companies kept on powering their way through. The earnings were strong. In fact, they got stronger because the weaker competitors did not have access to funding and et cetera. So highly profitable companies that have very high margins, generate a lot of cash, they just keep, regardless of inflation or deflation environment, they just keep powering ahead. They've got pricing power. Louis Vuitton has huge pricing power, right? Through the last 2 years, you know, even with inflation where it was, they were able to increase their prices well ahead of inflation. And guess what? If you look at, I mean, what have we had the last 2 years? We've had the Ukraine war, obviously, disaster, obviously, that's awful what's happening there. Rapidly rising inflation, rapidly rising interest rates, where their sales today are 50% higher than where they were in 2019. Okay, so if you were focused on the fundamentals, you'd be going, wow, that's interesting. You know, the share price has pulled back. Wow, that actually makes it more, it's always been attractive, but actually makes it look more attractive. So they're going to be highly profitable. And the second thing is you find with strong sustainable growth businesses, they have strong mega trends fueling them. So these are what I call, they're like tidal waves. They're unstoppable, they're very large, and they keep moving ahead regardless of what's happening around them. Right? So the economy goes up and down, but they just keep powering ahead. So if you can find those two elements in any business, you're going to get that sustainable earnings growth. And so that's what we look for in every stock in our portfolio. So if you look at the Insync portfolio, we've invested in 30 stocks across 16 global megatrends. You know, this mixture of tech and a lot of non-tech megatrends. I might just touch on a couple very quickly. I know I've got to be very punchy around this, so get some funny looks in a second. But if you look at the silver economy, aging population, you know, there's going to be, you know, number of people over the age of 55 is going to double within the next 15 to 20 years. There's going to be 2 billion people. Okay, and as you get older, unfortunately, a big issue is chronic diseases and heart attacks. So again, changes in the economic cycle to inflation isn't going to change the path of that. The demand for products and services to that aging population with chronic diseases is going to continue to accelerate. And again, the key thing is it's not only a great trend, you can find some incredibly profitable companies. Okay, these are, you know, we use return on invested capital, return on equity. We prefer return on invested capital, but you know, the portfolio at the moment has an average return on invested capital of 40%. That's 2.5 times the market average. Okay, so when we say quality, there's shades of quality, right? You might hear different people saying we own quality portfolio, we own, well, you've got to look at the metrics, I think, and I think the proof's in the pudding at the end of the day. Another good one is pet humanization. You know, we're increasingly treating pets like humans. That was growing at 2 times GDP pre-COVID, now is growing at 3 times GDP. Okay, if you look at the companies in that space, their sales have grown by 45% in the last 2 years. Right, through this volatility, uncertainty, everyone's been looking top down, but these types of businesses just continue to power ahead. So, you know, if you have a portfolio of companies that have those characteristics, very high levels of profitability, return on capital, return on equity, high net margins, debt-free, strong free cash flow generation, whether we're moving into a deflationary shock again, possibly, or whether inflation is going to continue to be part of the landscape for another year or two, these companies, you know, with their financial metrics, their market positioning, their existing profitability, the fact that they don't have to rely on external debt, we believe are well-positioned companies to continue to move forward in what we think will continue to be very uncertain times. So thank you with that.
Terrific, thank you.
Good afternoon, everyone, and it's my pleasure to be here today to visit Sydney after, well, the last time I visited Sydney was 10 years ago, so it's really good to be back, and I'm sorry I brought the bad weather along with me. I'll spend the next few minutes talking about our investment philosophy, which, as you can see from the quality view here, is that we are quality-focused investors, and I think this really ties in with what Monik has mentioned just now with regard to our focus on finding good quality companies that are able to grow regardless of whatever situation that we are in. And this is really because companies that are good, they will take advantage of the downturn in the cycle and, you know, buy up assets that may be on fire sales, and they will emerge stronger as well. So just a few words to define what we mean by quality. Generally, we are trying to find companies that are able to grow in a sustainable manner. So you will see that ESG is an important part of our quality overall assessment. The fund that we run in this space is an Asian Sustainable Fund as well, and ESG is one that helps to protect the downside risk. And over the long term, if you believe that Asia is in a very early stage of ESG investing, this will translate into an ESG alpha over the long term as well. Ultimately, we look for companies that are well run by management, good, strong track record that is executing the strategy that they have communicated to us. We look for companies with strong competitive advantage. and also companies that have a good industry growth dynamics, and we can talk about a bit of that later. Superior financials is extremely important, especially in the current times. So balance sheet is important. Our portfolio is net cash against the benchmark. So I think that is the testament of the quantitative side of things for our portfolio quality. What we have put together here very quickly will be the key investment themes. So this is the broader themes that you see in Asia. So we run an Asian portfolio, and these are the 6 themes that we think will be driving the long-term structural growth opportunities in Asia. Just quickly going through them. The first is aspiration and building Asia. This would be, the fundamentals that you know Asia for. It will be the rise of middle class. So Asia is expected to have 2/3 of the world's middle class by 2030. If you talk about GDP growth, this year, 2023, Asia will actually be almost half of the global's GDP as well. So increasingly, Asia is very important, and aspiration is really about consumption, premiumization of consumption, as well as China reopening. Building Asia would be really about developing parts of Asia. So you will be thinking about investments in India, for example, where we have a sizable investment there. It will be like cement companies, as well as companies that provide housing mortgages in India. And as you know, housing is an underpenetrated category in India. The third bucket, digital future, this is really about digitalization. This is a space that has really seen a big acceleration because of COVID. I think we all have adopted the online work in some way, going back down to hybrid working. But I think in terms of online penetration, this has really stepped up during this time. And the other theme that is linked to this is really about software localization. This is the big theme that we see in China today, and this is linked to the broader government's agenda. The next one is about going green, and this is about green energy transition. If you don't already know, Asia is also the global suppliers in terms of going green, and will help the world to accelerate towards that effort. Health and wellness is about aging Asia. So out of the 2 billion people that Monik has mentioned, a large part of that will be in China. So China is going to age pretty quickly, and we want to be invested in companies that help the government to bring down the healthcare and aging costs as well. The last bit is tech enablers. This has suffered last year. This will be the semiconductors company in Asia. And, but they are going to be well positioned for the long-term structural growth, whether you think of 5G, whether you think of artificial intelligence, or increasingly the digitalized world that we live in today. So in conclusion, I breezed through that very quickly. We are, in terms of our style, we are driven by people. So the team in Asia is about 41 strong team in Asia in terms of fund managers and analysts. So we really help you to do the bottom-up work, visiting companies. I'm also here visiting Australian companies, for example. I'm doing a dual role here. And we are quality-focused and active investors taking a differentiated view to the market. ESG integration is an important part of our quality process. And we try to effective change through engagement, and over time help to generate that ESG alpha for our companies as well as for our investors. We have a long-term credible track record. So we just celebrated our 30 years anniversary in Asia last year, and the fund, which we have just launched an ETF last year under the ticker ASAO, we are now 20 years track record of that fund. And the last bit is, it's been challenging times, to say the least, over the last few years, and we believe that this year will continue to be a challenging time. But for us, this really means that it presents opportunities because of the fear and the mispricing in the market, allow us to pick up quality stocks that have been sold off and position the portfolio for the long term. So thank you very much.
Terrific, thank you. We've seen some very significant dispersion in equities. We saw a rotation from growth to value. Do you think that dispersion will continue? Do you think there will be a reverse rotation of what performed well last year will perform less well in the next 12, 18 months? Or do we think we'll have more of the same? Perhaps we just go down the line, start with you, Alex.
I think this year we're going to see more dispersion. I think so I mentioned we've kind of moved to low vol. We think that's going to be where the positive dispersion is going to be. I think growth is still going to challenge in that high interest rate environment. The big question for us that we're kind of thinking ahead now is if a recession ensues, we're pretty convicted that the Fed will cut rates pretty aggressively. And how does growth respond to that? Or is there signs of what we've seen in the last, call it 2 weeks? Is there real problems in the tech sector that are going to be more challenging from a structural basis? And that's probably the biggest question as we get towards the end of this year, that we're still quite cautious on the growth of the tech names right now. But I think if we get more downside being priced in, I think that probably presents an attractive opportunity coming out of the recession.
Monik?
Clearly last year everyone was sort of rotating slightly into value. And the prior 2 years was all about growth because interest rates were very low. So when we had a change in the interest rate environment, then everyone moved into value. Historically, investors move into value when you get what's called a steepening yield curve and you expect the economic growth to really be quite strong in the years ahead. Okay, and that's where value stocks typically do well because they tend to be, I'm being very general here, sort of more cyclically and economically sensitive dependent. So that's when they do very, very well. So, but not all value did very last year. I think it was quite specific, like energy and commodity was probably the standout. The year prior to that was obviously low interest rate meant that we just had crazy valuations across the general growth sector. I think going forward, it's interesting, clearly we're in a very difficult environment where there's a high chance of recession risk, but interest rates remain very, very high. So both growth and value sectors from our perspective will be under pressure. And that's where I think, quality is generally done very, very well. If you look at the history, if you go through every cycle, quality ends up still being the outperforming sector. I almost believe it's an asset class by itself, to be honest with you, what I call quality growth. When I say quality growth, I'm talking about really profitable companies, as I mentioned, that had the sustainable growth path behind it, and where the earnings dependability is much greater. So I think you're taking on much less risk going forward when you invest in that space. So, and I think you're already starting to see that in the last few months. All growth stocks were hit pretty hard, quality, whether they were quality or not. So unprofitable growth stocks got hit very hard, but even the companies that had really superior metrics got hit quite hard, and that happens from time to time. But I think going forward, we're already starting to notice that companies that have started to deliver, which they have, including some of the tech names. So, you can brandish technology and just say they're all overvalued or they've all got problems. They don't. There's some very profitable tech companies that are in semiconductors to, enterprise digitization, and some of the Microsofts to the KLA-Tencor, which does all the testing equipment for semiconductors. Their earnings just keep powering ahead, to be honest with you. So, so a bit of a long answer, but I suspect that it will be back towards those more dependable companies that are delivering consistent profit growth.
Terrific. And Pruxel, your thoughts? Perhaps, obviously, you're from Chinese equities expertise. You manage Asian equities. Is there any difference from what we've just heard from Alex and Monik?
Yeah, I would say very similar, but probably given that I manage Asian equities, I'll answer it from a slightly different angle. In a sense that if you look at the key development last year, what stood out is that it should be an environment that quality outperformed, but actually quality has massively underperformed value last year from an Asian perspective. And we felt that a lot of that is driven by what's happening at the macro level. So if you look at the development last year, it has been very eventful and unique, to say the least. You have the Ukraine and Russia situation, you have China political transition and then zero COVID pivot, you have inflation debate turning into recession debate. So all these have clouded, the fundamentals, and a lot of this coincided with the sell-off in semiconductors as well. So if you look at, again, the dispersion in terms of the market performance last year, you'll have the North Asian markets underperforming. So Taiwan, Korea were the worst performers, followed by China, and ASEAN generally outperform. You have India having a strong performance last year, and then by sectors, information technology, which is also tied to Korea and Taiwan, have underperformed, and communication services, which basically is China Internet, has underperformed as well. And again, I think if we were to look forward into this year, there is a case of things, start to reverse, it's not just a case of mean reversion. We actually think that there will be fundamental reasons as to why this will start to reverse as well. So, for example, if you look at China this year, overall we are, I think this goes back to your point, Alex, about how we think that China, from a positioning perspective, is in a different position from the rest of the world this year, whether you think about the macroeconomic conditions. Inflation is not an issue, rates are low, growth has been cut, basically, and valuation is low. So China is looking pretty attractive, and it's a matter of it executing and continue to reopen, and that should spill over to the rest of Asia. So I think China will revert and has a good chance to do that. And if you look at the latest performance by year-to-date, Taiwan and Korea have also started to outperform pretty strongly, and a lot of that is really because they were oversold last year, so some of these stocks were looking pretty attractive. Whether they will continue to outperform for the rest of 2023 remains to be seen, because earnings visibility is low in semiconductors. People talk about second half recovery, but the pace of recovery is unknown. But I think 2024 is a clearer picture.
Terrific. You talked about earnings, and obviously earnings to date has been fairly resistant to any weakness, and in fact we're seeing earnings strength relative to expectations, and certainly there's no more downgrades from companies than normal reporting seasons, particularly in Australia. Do we expect weakness in earnings? Do we expect it to be broad-based from the rapid rise in interest rates? Obviously, as the discount rate rises, projects and prospective projects by any business become marginalised to some extent in their growth opportunity, their opportunity to go and invest, open new stores, open new whatever. Is there any prospect, or are you forecasting prospect for earnings downgrades, and is it going to be broad-based, and how do you, I suppose, position for that?
So yeah, we do expect more downgrades, and we've seen a fair bit of downgrades from the consensus expectations. We're at 7.5% in September last year, when now I think the US is pretty much flat. There's no earnings growth expected for 2023. Normal recession, you get 15% roughly of earnings downgrade. I think there's probably a reason to think that it's going to be less than that, maybe 5 to 10%. We think it's a pretty moderate recession. In a period where inflation is still a little bit higher than normal, you can get a bit more pass-through. The thing that is kind of the big question mark, and probably to the quality point, is about margins. You've seen a lot of pressure on margins already, coming through in consensus, but they're still pretty lofty compared to where they would normally sit, even before we had COVID. So I think that's where you're going to see a lot of that dispersion coming through as well, is how sustainable are companies holding onto those margins, and to what extent are they going to do things like lay off staff or other ways to cost cut to try and maintain that margin, because you don't have to have much for falling margins at this point to get to a -4 or -5% earnings contraction. So I think that's really the question this year is going to be the market's focused on, is how sustainable are your margins, and what's your outlook for your margins?
Monik?
So typically you've got to look at it stock-by-stock basis, but the market, the buy side, what I call the market, is normally ahead of the sell side, which is consensus. So they do all the work. So while the consensus is downgrading earnings, the market's already priced that into the stock prices. So perhaps I can give a local example, even though I'm a global investor, just to make it related. So if you just look at a stock like James Hardie, for example, everyone knows the housing market's doing it pretty tough. I think it's a pretty good company, well positioned. There's still a severe housing shortage, structural shortage in the US, but there's obviously a cyclical downturn for obvious reasons. We all understand why. And the stock's back from $60 to $30, right? So, they've had 3 downgrades. I don't invest in James Hardie, but it's just trying to make it relatable. Even with all the downgrades, the stock's not falling any further. They've had 3 downgrades now. So and we saw this in 2008. Normally, when the last downgrades come through, the stock's already up 30%, because the market's looking ahead 12 to 18 months. So I think you've got to look at it. I mean, there are still perhaps some other stocks and sectors that are susceptible to downgrades that the market hasn't captured yet. But certainly, I think the market has done a lot of the work on those stocks that were probably at highest risk. What it hasn't probably factored in is a GFC-style recession. Then you get your 15 to 20% downgrades coming through.
And again, I would say quality companies, the ones that I've spoken about with all those attributes, tend to be better positioned because their margins are a lot higher. And some of them have spent a lot of money during the bubble period, and you can see that they've got the levers to bring back the costs to manage through this period as well.
Yep. So the good news for Asia is that we have been through the downgrades, which have been pretty painful. While I think it seems like, given where the US is today, the forecast still have some way to go. So Asia will be first in and first out in terms of earnings downgrade. And a lot of that earnings downgrade in Asia has actually comes from the more cyclical sectors, such as semiconductors in Taiwan and Korea as well. So we are talking even for this year, consensus forecast for Korea is down about 33% in terms of EPS earnings negative. And a lot of that will be driven by, the memory semiconductor names that is actually still going through that negative earnings revision. So I think for Asia, we are hitting the bottom in terms of earnings downgrade. So when you look at PE, and again, back to your point about how things will bounce before that, we are probably in a pretty good shape. But overall, it has to be company specific.
Sure. And so in 2007, the market was a difficult year. At the start of 2008, there was this kind of relax, we've had a bad year. To what extent is there risk that occurs this year? That last year was a bad year. January, clearly everyone was kind of saying things are okay now. Last month or so, and particularly with what's happened over the last few days, it's become a little bit more marginal. But certainly you got a sense that this year people are feeling relief and that everything's okay. Do you think that is a potential outcome, or are you really positioning for recession, be defensive, be quality, be low volatility, and just bet the house on recession? I know a lot of you are bottom up, so you don't really think of it in that light, but to the extent that you take those macro factors into consideration, which of those two angles are you kind of coming from?
So we're not, I'd say we're not fully battening down the hatches, but we're certainly defensive. So I mentioned in the global equities book, we've moved more towards lower volatility. On a multi-asset perspective, like our most favored asset class right now is government bonds. We think duration looks pretty attractive, mainly because the valuations look good. It's provide diversification if we get more downside, and there really isn't this is easy to say on Friday, there isn't much of a recession price into government bond curves. So look, there's still a chance that we get that no landing scenario, but I think that what you saw through January is this hope that the economy has looked pretty healthy. A lot of the stuff that people were looking at was lagging indicators, like the labor market lags the economy. And this idea that the Fed would be kind of pausing, and we've kind of seen a ratcheting up again through last month. The Fed aren't going to stop at 5, they're going to go to 5.25, 5.5, where we've fallen now. I think that's kind of the dynamic, is this idea that we're going to get that no landing with the Fed like cooling off. The market's kind of said, okay, now we actually can't see that happening. The Fed are going to have to crush the economy.
Monik?
Yeah, 07 and 08 compared to now is very different, as you would appreciate. So that was a full-on credit crisis, and so structurally for the economy, that's very negative. I remember walking around the streets in 09, and the reasons why there were many things open it was a proper recession we had back then. So it is different from that perspective. Quality is inherently, I think, aggressive and defensive at the same time, because they're growing their earnings, but they've got all the elements of defensive properties sitting within that. Last year was a difficult year for quality growth, namely not just growth. Growth is sort of revenues but no profits, and they deserve to probably be punished. Perhaps some of the quality names were a little bit expensive in the short term, but the valuation compression has largely occurred that now. But as I said, the earnings, last year's earnings, in fact, if you look at the earnings across our portfolio last year, it was 8%, not adjusting for the impact of currency. If you do it on a constant currency basis, which is basically taking last year's exchange rate rather than this year's exchange rate, just saying, assuming the earnings were delivered exactly on the same basis last year, they're actually up double digit. That's not a recession to me. Everyone's saying it's been difficult for earnings. It hasn't. So I think that's the case. And I think selectively in some quality names, I mean, there are opportunities, as I said a bit earlier, where they've already been priced in. So even if you are concerned about, that, there'll be another difficult year for the economy, you've got to look at it on a stock-by-stock basis, and there are opportunities sitting there saying, okay, this is already priced that in. So in fact, you want to start getting assertive in some of those names because it's already fully reflected in the share price.
Brooksa?
Yeah, so we don't think that everything is okay. We actually think that things are still pretty uncertain, but we are probably not looking at 2008 scenario of the GFC either. So probably more of a mild recession if there is any, and that's our where we are today in terms of our base case. But I think what's more important for us is that it's really not a difficult situation today to be focusing on quality, simply because quality has been sold off so much last year. So this year, the usual quality premium that you'll be paying for is not really there. So you are actually getting good quality companies at good price, and some of that continues to grow regardless of the situation. So just to give you an example, we run a dedicated China A share funds as well as part of the overall offering that we have. And essentially last year, there's a lot of macro news about China and a lot of fear surrounding China. China GDP ended up growing at about 3%. Our portfolio, after being impacted by the sudden pivot of the zero COVID policy, the EPS was about 20%. So I think it really pays to be selective in some of these markets, and quality will continue to grow, and enjoying both the downside protection because they will be more resilient, you have more earnings visibility, and when things comes back, these other companies will outgrow the industry as well if you align yourself to the broader investment growth opportunities. So I would say that it's really not a difficult situation to be positioned for quality today, especially in Asia.
Terrific. We might go to questions from the floor. A couple of mics at the back. Any questions from the floor? David?
Thank you. I get that generally you're not macro people, but a lot of positive things about China I've heard and the prospects for China, but we've seen, the demographic issues, still trying to sort out what's going on post-COVID. We've had and financial and CEOs disappearing for months on end. How much risk do you see in China? Is there a lot of risk in the sort of rosy outlook some of you have been talking about there?
Is that for me? Yeah. Okay. So China is a risky market and will continue to be a risky market. That's why it really pays to be an active investor in China, and it really pays to focus on quality in China because it helps you to navigate all this, risk that is out of our control. Some of the risks that you mentioned, fortunately, is turning into a positive territory this year. So we have been through a large regulatory clampdown. This year, we have just finished the 2 sessions yesterday as well. And the key message from the government has been pretty consistent from November last year. And I think this coincides with the rise in the Chinese equity market. And essentially, it's really about being pro-growth. So they talk about a GDP growth target of 5% this year. They talk about property stability. So after a terrible year in terms of clamping down the property market to bring down the leverage in the economy last year, property should be stable this year. And this year is really a story about consumption in China, which we are seeing very good early signs of that coming through, and that should continue to be the case. So I think we remain pretty optimistic about China this year, but really China is not without risk. People forget about that. And I think last year it was a good reminder for everyone how risky China is as a market.
Can I?
Yeah.
Yep. We're very enthused about China, but probably from a slightly different angle. There's $2.6 trillion sitting in household deposits in China that needs to be spent. So I think the consumption story there is incredibly powerful in the years ahead. But the way we would invest through Insync, as you would probably gather, is probably through some of those companies that are highly desirable by Chinese consumers. And so the 2 areas that are most notable is around luxury, obviously, and travel is the other one. So if you look at some of the recent travel stats, you look at short-haul travel in China, it's running ahead of 2019 already. And then general travel is about 18-19% of where it was last year, and that's only likely to accelerate. And that's just a part of a global trend generally. So we think there's some tremendous companies available outside of China that give you that exposure to that really powerful consumption story coming through. But I still think there's a lot of risk there. I mean, we did a lot of work and actually got out of China in 2019 because we started to see similarities between what Xi Jinping was doing, what Mao Zedong did many years ago, which is, state was starting to have a really powerful influence on businesses, and that creates an unintended or unexpected outcomes. We just don't know what the next move is going to be. So whilst it might be positive in the short term, it could turn very, very negative very, very quickly. And so that whole thing, and if you think it's ESG, the governance, well, there's no transparency around the governance, and we just think there's a reason why multiples are very low in China in the same way, which is much more extreme, I appreciate, but multiples also very low in Russia, right? So there's the big discount factor there. And so we, from our perspective, and I think there are certain managers who can pick the eyes out of the market and do a very good job there, but from our perspective, it's uninvestable.
Any other questions? Yes?
Can I ask more for the stock pickers? I think you've inferred that sell-side research reflects consensus, gets priced in, and probably of limited help to stock pickers. So we also ignore the top-down, which is impossible to forecast. So when you actually go and meet companies and actually see the whites of management's eyes, what are you really looking for to give you that comfort which you're not getting from sell-side research?
I suppose that's for me. I'm a stock picker, and I'll be spending a couple of days next week actually visiting some of the Australian companies and looking into the management eyes, as you have mentioned. I'll look for a few things. As you know, sell side is a bit behind the curve. So that means that we have to do our own homework and making sure that we have a proper view of where earnings growth is going to be. So in the short term, it's really about, the certainty of earnings growth according to the strategy, and over the long term, it is really about how they invest and make sure that the sustainable advantage actually continues for the long term. So maybe it might be easier if I give a stock example. So for example, if we take BHP, which is a well-known Australian stock that we invested in our broader Asian funds, the short term for BHP is that they continue to actually bring down the cost per ton of their iron ore. They have done this pretty consistently and better than Rio Tinto. I hope no one knows Rio Tinto here as well. But essentially, they have been really good at bringing down the cost per ton, and that means that they are at the lower end of the cost curve, giving them the buffer in terms of valuation when iron ore prices decline. But currently, we are at the other end of the spectrum where iron ore prices are staying higher for longer, and that's really because of the expected demand coming from China reopening. But over the midterm, what we like about BHP is that they have been taking opportunities to actually invest and grow in the key assets that will be the future growth, aligning to the long-term structural growth of Asia and globally. So if you look at the assets they have been investing in, they are growing from iron ore into copper, into nickel, and essentially, if you think, people might not know this, but actually if the world decarbonize more and move more towards green, renewable energy, you will actually need a lot more copper, you will actually need a lot more nickel, and you will also, over time, need some more steel structures as well. So that's the long-term structural story. So it's really looking at those strategies, see how they execute, hold management accountable to it, and if times are tough, ask them the tough questions as well.
Toby?
Yeah, I've got a question. Alex, you put up a list of the managers who are in your portfolios. So we've heard a number of. You've expressed a number of views about how you should be structured, and we've heard a number of others. How do you look to achieve sort of consistency with your view, for example, amongst a set of disparate and unrelated managers?
It's a good question. So we have a lot of in-house risk analytics, and so we can kind of see how when you blend those portfolio managers together or the management houses together, where the risks are sitting and whether they align with our house view. It's not that we won't hire a manager if they have a different view. Like we're welcome to have, we welcome people having different views, but it's really about on that blended basis, how we see those risks coming out and where that would sit relative to our house view. And then on top of that, we have, without getting dorky, we have our own positioning strategy that we can use to fill holes. So a good example in Australia is through last year, like most managers are underweight the banks in our Australian equities fund. So we had this big hole of underweight banks, and we got to the point that we weren't that comfortable with it. So we can use that to kind of align the portfolio at the end level with our house view by using that positioning strategy to kind of plug some of the gaps if we see that there's just stuff that just we're not comfortable with those risks.
Well, we've hitting with 43 seconds to go. There's probably lots of questions we can ask, but thank you very much for your insights, and thank you to the audience for the questions.